Welcome back to Investing Talk Podcast.
Today we're looking at Lucid Group. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. We've got quite a bit of recent data and some upcoming catalysts for Lucid Group. We really need to balance the huge growth potential against the current financial picture.
Yeah, let's start right there with the financials, because the numbers, they kind of pull in opposite directions, don't they?
They really do.
On one hand, you've got this strong revenue growth. What was it? $807.83 million in 2024.
Yep, that's right. And it's up sharply, 35.71% year over year.
So that tells you, okay, they are scaling deliveries. People are buying these luxury cars.
Absolutely. Demand seems solid for the Air sedan, but, that scaling costs money. A lot of money right now.
Okay, so what does the bottom line look like?
Well, that's where it gets concerning. For the trailing 12 months, a net loss of, wait for it, minus $3.06 billion.
Oof, $3 billion. And that's not shrinking.
No, that's the kicker. It actually increased about 8.24% from the previous year. It's all driven by these massive upfront investments.
Yeah.
Manufacturing, R&D.
Right. Building factories isn't cheap. So high growth, but also high burn. That's the core trade-off you mentioned.
Exactly.
But are they running out of cash? I mean, with losses like that?
That's the crucial question. And the answer, for now anyway, is no. Despite the negative free cash flow, which, you expect in this phase, their liquidity is actually pretty abundant. They finished Q2 with a strong cash position, $5.76 billion.
Okay, $5.76 billion in cash against a $3.06 billion annual loss rate.
Right. So doing the rough math, that gives them, a bit under 2 years of runway, maybe around 23 months at the current burn rate.
Seems okay, but not forever. That clock is definitely ticking, especially with their production goals.
It really is. The balance sheet's solid for now. Debt seems manageable. It gives them flexibility to keep investing, but they have to hit those volume targets to make this work long term.
Okay, so the financials are precarious but buffered, which brings us back to, why are people still so interested? Why hasn't Wall Street just, given up?
Well, that comes down to the product and the tech. It's their competitive edge, their moat, really.
They've definitely positioned themselves as premium EV, right? Competing with the big luxury names.
For sure. They're going head-to-head with Mercedes, high-end Teslas. But it's not just a nice-looking car. It's what's underneath.
The technology. Let's unpack that. What makes it stand out?
It's their own proprietary stuff.
Yeah.
Drivetrain, battery systems.
Yeah.
Engineered for, crazy efficiency. The headline number is the range. Industry-leading, over 500 miles for the Air.
500 miles is huge.
It is, but maybe even more important is the efficiency. They hit 5 miles per kilowatt hour. That's like a new benchmark.
And why does that efficiency number matter so much? Isn't range the main thing?
Well, yes and no. That efficiency, you see, it changes everything. It means they can potentially use a smaller battery pack to get the same range as a competitor.
Smaller means lighter and cheaper.
Exactly. Lighter improves handling and, ultimately it should lower manufacturing costs once they get to scale. So that vertical integration, doing it all in-house, it supports that tech leadership. It helps justify the price tag too. They're kind of winning the powertrain race at the moment.
Okay, so great tech for luxury cars. But then there was that other news, the strategic stuff.
Oh yeah, that was big.
In July 2025, the stock jumped. What was it, 36%, after they announced that robo-taxi partnership.
Right, with Uber and Nuro. That was a massive deal.
Huge validation, right?
Yeah.
Using their tech for autonomous ride-hailing.
Totally. It signals their tech isn't just for rich individuals. It's robust enough for demanding commercial use. A big strategic win, validating the core platform.
But were there concerns about that deal, too? I remember reading something.
Yeah, there was some analyst chatter about that. The concern was, okay, if Uber and Nuro own the fleets, does that limit Lucid's recurring revenue? Like, are they giving up the chance for higher margin service income, the kind Tesla gets, just to sell the cars up front?
Sacrificing the ecosystem for initial volume. Maybe a necessary trade-off given those losses. They need the volume.
That's probably the thinking. Get the cars out there, fill the factories. And speaking of volume, Q2 deliveries were pretty solid.
How solid?
3,109 vehicles delivered. That's up 58% year over year.
Okay, decent growth there.
And crucially, they reaffirmed their target. 20,000 vehicles for the full year 2025. Hitting that number is everything right now for credibility.
Yeah, execution on volume. That seems to be the theme. Okay, let's shift gears. What about the stock itself? the technical picture.
Yeah.
As of, say, November 1st, 2025.
All right, so the stock's trading around $17.75.
$17.75. And the moving averages?
Good news for the bulls there. It's well above its 200-day simple moving average. That's way down at $6.36.
So that long, painful downtrend seems to be over.
It's like it. Trading above the 200-day suggests the long-term momentum isn't fundamentally bearish anymore. That's a big shift from last year.
And the shorter-term 50-day?
It's trading right near that. The 50-day is around $18.01.
So close to $18, right where the stock is now. What does that tell us?
It's just we're at a key short-term point, probably seeing some consolidation, maybe some volatility right here as traders figure out the next move. A lot of debate happening at this price level.
Okay, so what's the short-term forecast looking like?
Pretty tight, actually. The model suggests a 3-month range between, say, $17.26 and $18.90. The key support seems to be right around that $17.72 mark.
So sideways for a bit, maybe. Waiting for news?
Seems likely. But the real optimism, it isn't in the short-term wiggles. It's in the longer-term analyst targets.
Yes, the price targets. Where are those sitting?
The 12-month average forecast is, well, it's quite a bit higher. It's in a range between $24.24 and $28.38.
Okay, so $24, $28 roughly.
Yeah.
Compared to $17.75 now,
that represents about 31% to 56% upside from current levels. Pretty significant potential return baked in there.
But I also saw some crazy high targets, like $50.
Yeah, you do see those outliers. Targets up to $50. Which, honestly, that massive gap between the current price, the average target around $26, and that $50 outlier, it just perfectly sums up the story, doesn't it? High risk, high potential reward.
But wait, if the consensus rating is just hold, how do we square that with those high targets? Are the hold analysts just being cautious?
That's a really important point. The consensus, 8 holds, 2 buys, 3 sells, reflects that caution. They see the execution risk, the profitability gap.
So the $50 target, folks, what are they betting on?
They're likely betting less on Lucid becoming profitable organically anytime soon and more on the value of the intellectual property. That $50 view is probably a bet on an acquisition by a major automaker wanting their tech, or maybe a huge strategic investment, perhaps from the Middle East. It's an M&A bet, not necessarily an organic growth bet.
Interesting distinction. Okay, so connecting all this,
all right.
What are the immediate triggers? The near-term events that could move the needle significantly?
The big one is right around the corner. Q3 earnings, scheduled for November 7th, 2025.
Okay, earnings. What are people watching for specifically?
2 main things. First, obviously, delivery numbers. Are they still on track for that 20,000 vehicle target for the year?
Right. Continued ramp success.
But second, and arguably more critical this time, evidence of improving gross margins.
The cost side. Are they getting cheaper to build per car?
Exactly. We need to see that the cost of goods sold is starting to fall relative to the sale price as volume increases. If those margins start to widen positively, that changes the whole narrative.
That's the path to profitability, however distant. What else? Any product news?
Yes. The other major catalyst is the delivery ramp for the Lucid Gravity SUV.
The SUV.
Yeah.
That's supposed to be big for them, right?
Huge. Getting into the luxury SUV segment, which is incredibly popular and profitable, that should fuel a lot of new demand. It broadens their market way beyond just sedans. That's really the volume driver for 2026.
So concrete things, Q3 earnings, focusing on margins, and the Gravity ramp up. What about the rumors?
The speculation. Well, it's persistent. You keep hearing chatter about potential new strategic collaborations, often linked to the Middle East, given the Saudi investment.
And the M&A talk you mentioned earlier?
Yeah, that's always simmering in the background. Because their battery and powertrain tech is considered so leading edge, there's always this idea that a big legacy automaker might just want to buy them for the IP. Pure speculation, though.
Got it. Speculation is exciting, but we have to balance it with the risks. What are the main hurdles?
Execution risk is number one. Scaling production this aggressively is incredibly hard. They're using new manufacturing processes, scaling new tech. Any hiccups, supply chain issues, delays, cost overruns could really hurt sentiment and, more importantly, burn through that cash faster than planned.
So immense pressure on management. Hit the volume targets and control costs to stop that $3 billion loss bleed.
It's a real tightrope walk for the next, say, 12 to 18 months. Their ability to execute on cost controls and manufacturing efficiency is absolutely crucial. That's what will justify the current valuation and those optimistic targets.
Okay, so wrapping this up, for you, the listener, what's the takeaway? Lucid clearly has impressive growth, A premium product with genuinely superior tech, the cash to keep going for a while, and analysts see significant upside.
And there's that massive profitability gap. It has to be filled by scaling volume efficiently, and that comes down to flawless execution. It's a compelling story, especially for long-term investors who can stomach the volatility.
Right. Aggressive growth, breakthrough tech makes it tempting.
Huh.
But you're betting on management navigating this race against time. You need to watch those Q3 margins and the gravity ramp like a hawk.
Exactly. Those are the real indicators.
So here's something to think about. Given that technical leadership, especially in batteries and powertrains, if you invest in Lucid today, are you really betting on them becoming the next great standalone car company? Or are you actually placing a bet that a global auto giant will eventually swoop in and buy them for their technology? What's the more likely end game here?